All right, class. Again, we're going to continue learning about investments. And so here are our goals or learning targets for this unit that we're going to focus on today. Normally I focus on all of these, but today we're just going to focus on what are the best assets to invest in. And we're going to learn some terms to help us figure out what are the best assets to invest in. And first, before we get into each specific asset, I want to talk about credit unions, banks, and savings and loans, which is something that you should have been working on last week. So let's talk about those. So a bank is any financial institution that takes in deposits and makes loans and helps individual businesses and governments to manage their money, and their goal is to earn profits. And so you have commercial banks, savings and loans associations, and credit unions. These are all technically banks. They're banking financial intermediaries. They're a little different, though, each of them in some ways. So how are they different? Well, first, a commercial bank. A commercial bank, it's privately owned. It was initially created to help out businesses, hence the word commercial. And so if you go to a commercial bank, let's go to one right now, let's go to their website. And here's the US Bank. And if you look right at the top of their webpage, it says Personal Business Wealth Management. So it's a commercial bank focusing on helping businesses and even governments. So that's the key to a commercial bank. Its focus, initially, they were all focused on helping businesses. And of course, they provide services like checking and savings accounts, loans, investment assistance, and credit cards, which all banks do, not just commercial banks. So credit unions and savings and loans do that too. The difference here is that they focus on businesses mostly. Of course, you can be a business working with a credit union and other places, but commercial banks specialize in that. So most of the time, if you're a business, you go there. And of course, this is why commercial banks are usually really big banks compared to your credit unions and your savings and loans. And of course, it's insured by the FDIC. And so what is the FDIC? It's that thing that it was created during the Great Depression to provide security so we wouldn't have a worse depression in case banks started closing down. And so they insure people's deposits of up to $250,000 in the bank. So I'd like to show you a video that describes the FDIC and can give you some assurance that the FDIC isn't going to go bankrupt anytime soon. It's not going to be an easy thing for this to happen. So here, let me show you this video.
There are few ironclad guarantees in life, but here's one. Federal Deposit Insurance. Americans have counted on it since 1934. In those days, the insured deposit limit was just $2,500. Today, it's 100 times that. But the promise is the same. Whenever you put money into FDIC-insured deposit accounts and stay within coverage limits, that money is 100% protected, no matter what happens to the bank or the economy. That's some guarantee to keep for more than 75 years. Here's how the FDIC is able to do it. Deposit insurance is exactly that, insurance. But unlike an auto or home policy, the consumer doesn't pay the premiums. Banks and savings institutions do. The FDIC is funded by the banking industry, not taxpayer money. The premiums go into the Deposit Insurance Fund. And as with any insurance, the higher the risk, the higher the premium. But what happens in times when bank failures are high and the fund is frequently tapped to protect depositors? There have been times when the fund has had a negative balance, even when it had abundant resources. This is because the FDIC is required to set aside a contingent reserve for probable failures over the next 12 months. The higher the projected failures, the greater that reserve must be. Since the FDIC is not allowed to offset that cost by future income, The net result on paper is a negative fund balance, even though total resources are positive. But whatever the fund balance, it does not affect the FDIC's ability to protect depositors when banks fail. The FDIC has access to considerable cash from many sources. Besides the money currently in the Deposit Insurance Fund, the FDIC receives quarterly premiums from the banking industry. It can also assess banks special fees and require them to pay premiums in advance. Then there are the unsold assets from failed banks. As these are sold, the proceeds are converted to cash. In 2009, the FDIC collected $10.2 billion in regular assessment revenues, plus another $5.6 billion in a special assessment. And at the end of the year, it required insured institutions to prepay 3 years' worth of insurance premiums. That raised another $46 billion. Based on current projections, the amount on hand will be more than sufficient to handle bank failures from the financial crisis that began in 2008. The FDIC is committed to doing everything possible to be solely funded by the banking industry and would only seek public funds as a last resort. In such an unlikely event, the FDIC has a $100 billion line of credit with the U.S. Treasury. And then there's the ultimate reassurance. The FDIC is backed by the full faith and credit of the United States government. No matter what the future brings, the FDIC will continue to be a symbol of confidence for America's banking public.
So, you might think to yourself, well, I sure hope that what they're saying is true, especially during this depression we're experiencing. But we'll have to wait and see. Either way, it's got some considerable assets in case some banks close down during this recession. And the banks have been considered essential work versus some non-essential businesses. And so it's been able to still hopefully keep alive its business going, so to speak. So hopefully it's not been as affected by this. Although they do give out loans, and if those businesses go bankrupt, I imagine there's going to be some banks that are going to have some issues, and the FDIC is going to have to pay out some money for those individual people who are banking at those banks. But anyway, so we'll see how this plays out. Either way, all commercial banks and savings and loans are insured by the FDIC. So what's the difference between a savings and loan and a commercial bank? Well, a savings and loan, their focus is on providing home mortgage loans. So it's like a membership where people will put money in for the purpose of lending out money for people to get mortgages on houses. There's not a lot of them around. There's none in Dubuque that I'm aware of. And so there's a very small number of institutions that are still considered savings and loans today. However, we do have a lot of credit unions in Dubuque. And so they're similar to SNLs and commercial banks, and they offer similar things like savings and checking accounts. But they not only do they specialize in mortgages, but they also specialize in auto loans. So if you're looking for a car loan, where's the first place you should look? Credit unions. Now, of course, you could also look at commercial banks and savings and loans. They also will provide auto loans, and they potentially may be better than a credit union. But credit unions are known for offering better rates because they're not for profit. And so they're able to offer better rates usually because of that. They're not insured by the FDIC, though. They're insured by something called the NCUA. Basically, same thing, same concept as the FDIC, just a different organization, a different insurance organization. The biggest difference between credit unions and banks, commercial banks, are that they have membership requirements. So you have to be a part of the medical profession or the construction profession or the education profession, or like Dupaco and Dutrac, which are local banks. Let's look at Dupaco together right now. So if you go to Dupaco's website and you click on the About, How to Join, you just need to live within the any of these counties in Iowa, and a few counties in Wisconsin, and a few counties in Illinois, right along the border. And so I can bank at Dupaco because I live in Grant County. So I'm good. However, could Bill Gates bank at Dupaco? If he doesn't have residence in any of these counties, then no, he technically cannot, even though he might be a rich dude, right? So each credit union has their own membership requirements. Some have to do with where you live, some have to do with where you work. Dupaco was originally for people who worked at the PAC. Dutrac was originally for people who worked at John Deere on tractors. Dutrac, right? So, anyways, so those are examples of credit unions in Dubuque. All right, so now let's see. Can you take a moment, pause the video, and match up the correct definitions with the correct terms? Pause the video now and do it. All right, so here's the correct answer. Commercial banks are a person must be initially they're created to provide loans to businesses. Savings and loans. Their original goal was to provide mortgages, home mortgages, and credit unions. A person has to be a member to bank at these places. Now you might say to yourself, Mr. Hanson, why are we talking about this? We're supposed to be talking about investments. Good question. Let me help you see the connection now. All right, so the reason why I talk about these different types of banks is because one of our first investments that a person can invest in has to do with putting your money in a bank. It's called a money market account, also known as a CD, which stands for Certificate of Deposit. And these are very low risk because they're insured by the FDIC or the NCUA if it's a credit union. And so there's the money market / CD, and they usually have very low interest rates because they're so low risk. Because the banks have to, in a sense, they want to guarantee the money there. And so it's not a variable thing. They promise you after this amount of time, a month, a year, 2 years, you'll get this percent back. So it's very low risk with very low returns. So let's talk about a difference here between low risk and low returns. All right, let's talk about the 4 categories of investments. Every investment, like a CD or a stock or lots of other things, fall into these 4 categories: risky versus non-risky, liquid versus non-liquid. So what does it mean? Well, risky means it's possible to lose your money. Makes sense, right? Return, though, is a little tricky. It is a profit or loss made on an investment. Now you get a return profit, but it's also the loss. That's the tricky part. So here's a graph that represents this. We've got a risk on one side, return on the other side. So as an asset becomes riskier, the more return it provides, which doesn't mean that if you choose the riskiest thing in the world, you guarantee yourself a lot of money. No. This means opportunity to lose or gain money, right? So higher risk, the higher opportunity for gain or loss. So a CD would probably be down here. It would be low risk, low return, right? Now the next category is liquid versus non-liquid. Easy access to your money or hard access to your money. So if I take a glass of water and I pour it upside down, the water comes out very easily. It's very liquid. So if I have an investment, I can easily turn that investment into cash, then it's considered liquid. However, there's some things like shaving cream or whipped cream, and I pour it in a glass, right? It's in the glass, and I try and turn it upside down. It may not come out very quickly. And so there are some investments that you put your money in, and it takes a while for you to get your money out because there's rules that are tied up, or it's hard to find someone to sell the product to. And so some things are considered liquid, some things are considered non-liquid. Now, looking at these little things here, We've got our piggy bank. What do you think? Liquid or non-liquid? The answer is liquid. It needs to get your money out. Just smash it open or pop open the cork and out comes the money, right? Very liquid. Now, risky, high risk, low risk, low risk. Unless you have a brother who's known for stealing all the time. So in general, it's low risk and very liquid. How about going to the casino? Is that a high risk or low risk? The answer is high risk, right? Is it high liquidity or low liquidity? Well, it's high liquidity because usually you go with a card and you can easily, when you're done, just go give them your card and they give you back your money that you won or the little bit that you have left, right? And so high liquidity, high risk. How about a house? Is a house risky? What do you think? High risk, low risk? Well, it depends. My guess is a house is I want to say medium risky, on the closer to the higher end, but not the highest riskiness. Of course, it depends on the area, and of course, things can always happen. Now, how about liquidity? Are houses known for high liquidity or low liquidity? My guess is they're going to, not my guess, I know they're very non-liquid because I could put a for sale sign out in front of my house right now, um, and someone might even want to buy it right now. But the problem is there's a bunch of rules that have to happen. We have to have my house be inspected by law. There's a bunch of other things that have to happen. And that is, even if I have someone who's willing to buy it, um, when I want to sell it immediately, which is usually unlikely as well. So houses are known for being more non-liquid. So every asset falls on a spectrum. So some assets might be very non-liquid and very low risk, and as a result, they're going to have, if something is more non-liquid and high risk, is more return. If something in general is liquid and low risk, it's low return. And so you can have some assets that are a mix, non-liquid and low risk, so they have a medium return. Some assets might have a different category where they're more high risk and closer to more being liquid. Again, that might have a little bit higher return than the last investment. It just depends. But every asset falls on the spectrum, and that's going to have an impact on how much return or less return the asset's going to provide. So now let's get into specific assets again, just like CDs and money markets.